All right. Welcome to Real Estate Hustlers podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Capital. Today we're joined with Jered Sturm. Jered is the founder and CEO of SNS Capital Group, a premier multifamily investment firm in Cincinnati, Ohio. Jered comes from a top technician and then is now as a top multifamily expert. Jered's 17 years in real estate has helped shape $150 million worth of assets under management. It's a powerhouse championing long-term value and community growth. Jered, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, Josh, thank you for having me, and thanks for everyone in the background who's working on editing and all the other things that go into producing this show. I'm super grateful to have the platform, so thank you. I appreciate the introduction, and I think we're in the same neck of the woods, and so here in the Midwest in Cincinnati, Ohio, and focused on large multifamilies, but the bio is a little bit out of date because it's been 18 years now I've been in the industry. So it's been a long run and one I've enjoyed, but started as a maintenance tech and then fast forward today have about 1,300 units in multifamily here in Cincinnati, Ohio.
That's incredible. Let's go all the way back to when you had 0 units.
Okay.
What that look like, and then what did it look like when you've decided to get into multifamily and then larger multifamily?
Yeah, so I mean, it was a slow start. I mean, different time. I got a very early start into real estate. So I bought my first investment property in 2008. Prior to that, I was a maintenance tech for another local landlord. So I was the guy, changing the toilets and hanging the blinds and painting the apartments. I did that during high school. My senior year, we had a program where I could work full time. So both myself and my brother, who's my business partner today, we were maintenance techs for this local landlord. And then working full time, making decent money. Once I graduated high school, I was able to buy me and my brother bought a 6-bedroom house. We lived in 2 of the bedrooms, rented out the other 4, and continued to work in the trades, doing like kitchens and bathrooms, additions for homeowners. And we had no formal training, but we always had a natural aptitude to work on in the trades and work on properties. So we would always just say yes and then figure it out along the way. And those results were pretty good. But then in 2008, we kind of looked around and said, hey, look at all these foreclosures. Why don't we start buying some of these and fixing them up ourselves? So we did single family small multis with our own capital for about 8 years. So that takes us to about 2015. And 2015 is when we made the jump into larger multifamilies. So it was a 8-year process to get us from, say, the first one into larger multifamilies. And then the last 8 years of our story are mid to large multifamilies, being like, say, 50 to 200 unit communities.
Got it. When you decided to find the bigger properties, to multifamily properties, what was the first bigger purchase, and then how did you find it, and then tell us about that process and that journey?
Yeah, so I think that's late 2015. It was a marketed deal, a little bit different time in the market. So it was just a marketed deal by a real estate broker. It was a 42 unit in Cincinnati, Ohio. I think the purchase price was $2.1 million. We didn't have any investors on that, but we had built up capital by renovating our existing portfolio, forcing appreciation into it, stripping that equity through refinances or debt restructures. And then in addition to that, we knew we needed more capital. And so for like most of the start of 2015, myself and my brother went out and flipped 15 houses. And so we're not house flippers, but we needed to generate cash and we had the skill set in the trades. So we did, and it was a good time in the market to be doing flips. Still some inventory from the Great Recession on the market, so we could easily scoop them up that had distress. And then it was becoming a seller's market around that time. And so it's a good time to generate some cash. That's how we did that. But that first one was, a $2 million transaction that there was no outside investment coming in.
Yeah, those are usually the base hits that turn into home runs too. When you found the property, you're going from homes, from smaller units to something of much more bigger, and figuring it out along the way. So when you got it under contract, with your skill set being in the trades, assuming you found out what the CapEx was, you found out what the repairs were needed. Tell us about that process of what you're looking for before you decide to go all the way through to closing.
So I would say that what we're looking for now would be slightly different than what that first deal was. So I know you said your audience is a lot of people who may be making that transition or thinking about it. So I'll talk about going from, the small multis, the single families to that 42 unit. A lot of people would think with, myself and my brother's background, we were looking for highly distressed deals that we could go in and do heavy value add on. But that wasn't the case because we're about making asymmetric bets, right? So we want to know that every bet we're making, there of course is downside. We want that downside to be less than the upside. And with at the time that being a very large investment for us and a new venture into, call it like mid-sized multifamily, we didn't want to add those variables of the heavy distress. So it was a relatively stable deal. It had dated interiors that we knew we could go in and improve those. So call it, at the time, probably $8,000 to $10,000 per unit in like cosmetic interior renovations. But it was a 1990s built brick exterior, pitched roof, pretty predictable, all the same floor plan. And so there was a level of predictability in this transaction that was comforting to us rather than say, let's make a giant leap into a 100-unit foreclosure with, 80 vacancies and, heavy distress, because it would just be, for us, it would just be too much new all at once. So our story is very organic growth. And while I got an early start, so I'm still relatively young, I think it's been slow and methodical is our approach.
Yeah, and as you acquire another building, you learn a little bit more knowledge, and another building. And plus, there's a balance. There's the acquisitions, but there's also operations behind it. If you become out of balance, that's where things start to break, and you have to have the problem in order to solve it. So you have to have a new acquisition of say 40 units in order to solve a problem on the back end for operations.
Mm-hmm.
You can't solve the problem if it's not there. So that's where growth is balanced and can be methodical. You can hire before say the 90 days. Say you're going to be heavy on the front end, so you go in and hire to prepare your staff for a new acquisition. But everything can be methodical and thought out, especially on multifamily. You know what you're getting into, and they are cash flowing when you make the purchase. If there might be some vacancies, some outdated units, but buy it right. Market is cash flowing, helps serve the debt while you're making your upgrades. Tell us about some lessons learned on your journey so far.
Well, I think building up my management company, we have, 50 employees now. So we not only have our property management that oversees our portfolio of 1,300 units. We don't do third-party management, but we also have our construction team in-house as well. And so what I've learned, and this has been applicable for all 16 years, is when we're real estate investors, we're chasing financial returns. And I think that's what gets a lot of attention on these types of platforms is like, look how much money we can make, which is true. But I think what the point or the lesson I want to convey is financial returns are supported by on-site operations. And then a lot of people know that, but the thing that gets missed is on-site operations are supported by the people who work there. So what we've been really intentional about is building good systems and processes to allow the team that we're hiring and building to implement, but really supporting them in that journey, because that's where the thing that gets everyone's attention, the financial returns, that's where it comes from. And I think a lot of people miss that. They think it comes from the specific asset, the specific market, and I'm more long-term hold. So I'm more focused on polishing my operations to produce those financial returns.
Yeah. We were using third party at first, of course, because we were focusing on the construction side, the renovations, and third party supporting the operations part. But it got to a point where we had to make a decision because we were putting third party in front of us, but they weren't making the same decisions that we would have made, overspending on items or leasing to to tenants that we might not have approved, so on and so forth. So once we took over operations, we've seen our business completely transform, and we've seen the performance of the properties uh, go exactly where they should have. Because now we're able to double down and lever different things and apply different pressures in different ways that third party just couldn't do. Communications are streamlined. You're able to put things in sync, keep your costs down, your cost low, recurring labor material at a different rate, and um, and the properties do what the properties should be with the right operators. Did you all ever have third party, or was it something that you all just started to do and started to snowball?
So it's a great question. Somewhere around 20 units. So this is more than a decade ago. We asked ourselves the question, do we want to build a true third party we were self-managing, but once we got to about 20 units, we said we either need to build a company that is going to support the property management arm of our company, or we're going to go third party. And the decision we made at that time was we're going to go third party. We want to focus on construction. The approach we took at that time was rather than go to the management companies, and this might be a nugget for your listeners, rather than go to the management company's corporate office and the sales team and ask them, what is your percentage split? Why are you better than the next guy? Blah, blah, blah. What we did was we found similar properties to what we owned in our portfolio at the time, and we went and toured them as if we were prospective tenants. And so I wanted to see how are they handling sales? How are they handling simple things like responsiveness? We planned to kind of test fair housing law, ask some questions to see if they would fall for the bait, things like that, to see how professional this company was. And Josh, fortunately for us, the results were so bad that we made the decision not to hand over the operations side of our business and pivot to vertically integrate. And this was 14 years ago or so. So we have since then been building up our own management company that supports our assets. So we never did third party management because we were testing the results from a customer's perspective and never found anyone that we trusted to hand that off to.
Yeah, that's huge, and the fact that you went through those that extent, going out there to test the property manager. I mean, that's huge because you're essentially giving your baby to someone else to manage the baby, and if they can't do the basics, that's a testament of what they're going to do.
Mhm.
And I think that in order to there's different ways of looking at this because there's the syndicators that syndicate the properties, and then they hand the property off to third party property management, which there are third party property managers that are beyond excellent. They've got an infrastructure set up to with an org chart that is massive, and they're able to support the properties at different capacities because of the resources. um, but at the same time, the syndicators don't have any control over the property's performance. They're relying on third party. So being an owner operator and a syndicator, in my opinion, is the most sustainable way of multifamily, the most sustainable way of being successful and ensuring success as best we can. What is your opinion with the way the current market is, and then how that affects syndicators and how that affects owner operators and syndicators?
Well, I guess I'll piggyback on more of a comment and say, like, I think it also depends on what asset you're buying, right? So, like, now where we have settled in and found success is, call it, above the mom and pop buyer, but below the institutional buyer. So for us, our portfolio is mostly made up of communities between 70 and 180 units, right? So to your point, like if I go down to say Texas or Florida and buy an A class 400 unit community, I can hire a very, very professional management company that will probably produce really, really good results. But if I have an 80 unit building in Cincinnati, Ohio, that's B class, like I'm most likely not going to find a management company that could do it anywhere near at, like the performance that we're trying to produce ourselves. Um, you said, how does the current market state impact syndicators? Are you saying specifically for third party management or just in general?
More of in general, because you've got the tides have turned. You've got different constraints on the market right now, as far as interest rates, as far as occupancy, as far as rent increases, what performance is versus actuals. Um, when you're an owner operator, you can lever different things and make certain things happen versus leaning on third party property management. But in your opinion, how is the current market affecting syndicators who rely on third party?
Uh, well, I think negatively, but the reason being is, as I said before, financial returns are supported by on-site operations. On-site operations are shored up by having control of them. And so anyone who has elected to outsource that is not in as strong of a position to be resilient to recessionary pressures, right? So whatever form that might come in, whether that's vacancy creeping up or turnover costs creeping up or payroll costs whatever it is, right? Having control of all of those components of the operations will make you more recession resistant. And I feel very fortunate that all of our portfolio has long-term fixed rate debt. But if you're an operator who chose to take bridge debt or floating debt and you are combating against that and you don't have control of this major lever of the operations, it's very challenging for you right now. Like, it's extremely challenging for you. So I feel fortunate that our portfolio is not in that position, but there are a lot of syndicators, probably the majority of them across the US, that actually go with the model of third party management.
Yeah. Yeah, and it's an arbitrage model. It makes it tough for the GP to actually see any kind of returns, and then there's cases where LPs are just hoping to see something.
Yeah.
But it's just the way that it is right now. On the getting back to the operations part for the construction side, you all have all of your construction teams in house, which is you could have 1099 guys out there that are just going to the job, getting the job done, but you all have chosen to have that in house.
Mhm.
Um, what does that look like on operations? And then, because that's cool, that's great. I mean, that's total control of the turn cycle.
Mhm.
How do you all manage that, and what does it look like?
I mean, it's evolved over the years. Right now, so we're buying C to B class multifamily that has distress. That distress could be like a foreclosure with a bunch of vacancies, highly beat up, or it could be just cosmetic upgrades of the interiors. But typically, our business model is not moving walls or rearranging floor plans. It's the typical, $10,000 to $15,000 per unit. All the interior cosmetics get refreshed, and that's what we're good at. So the org chart and how that business model relates to the staff that are W-2 employees is we have um, multiple project managers that oversee what we call turn teams. Our turn teams are made up of one turn lead and three turn techs, so a total of four tradesmen that are inside that apartment, led by a project manager. And so, yes, that's all handled in house. We also have five full-time cleaners that handle our common areas as well as cleans as they come off of the turnover workflow. And so we do have control of a lot of the processes, and that's intentional because, um, Josh, as you know, when trying to maximize financial returns and looking at an income statement, one of the biggest accounts that impact and trickle down is vacancy. And so controlling turnover, both from how many turns you have as well as how fast you can turn, is how we can then, we have 1,300 units. As of the start of this month, we were 99% occupied. And you might say, "Oh, raise your rents," right? But it's not necessarily that our rents are low because we actually feel we're above competitors. It's that we are not only good at reducing the number of turnovers, we're good at the speed at which we turn. So we know those KPIs and we track the components of vacancy of how long did it take to get to the turnover? How long did the construction crew take? How long did the leasing team take once the construction was finished? We know all those metrics and we're monitoring it because it's all in house.
What is your all's target turn for a unit? Just the tenant moves out yesterday. What is the target turn to get it back on the market and leasable?
So from resident move out to resident move in 2024, we have averaged 20 days. we're not that happy with that because we made 4 acquisitions at the tail end of 2023. So we had a bit of a backlog on the construction part. So I mentioned before, like vacancy has multiple components. The one where we were seeing the inflated lag time was waiting for our construction teams from the time the resident moves out to the construction to start. And so then we just said, like, well, how do we fix that problem, right? It was a backlog problem, which we have since cleared. To answer your question, going back to 2023, when we look at that, we averaged 7 days.
7 days,
So,
that's huge. That's good.
um, so we're and that's all to the credit of our team, because what's happening is we get in the workflow of that to get those impressive metrics is, a resident gives us 30 days notice. The property manager inputs that into the schedule. The project manager gets a notification. So then he or she is inputting that into the construction schedule. We know that it takes us about 2.5 days of work to renovate that apartment. And so we know to the date, here's when it will be ready. That's when, 45 days prior to the date it'll be ready is when our leasing team gets that notification and starts leasing to that date. So pre-leasing. And what they're so good at is lining up that date because they have trust in their team, right? So as you know, if you hire out a painter and a separate carpet guy and a separate cleaner, somebody drops the ball. And
Yeah.
then the leasing team has to have a conversation with a resident saying, "Hey, we got to wait." They lose trust in the process, so then they start building in a buffer. We have built the process and have control of the process to where our team trusts each other. And so the leasing team is just nailing that date. The unit's ready on April 1st, they move in April 1st. And we actually structured our leasing commission to incentivize that. So it's been, I guess that's a niche example of what I mean by being good at operations.
Yeah, and that's huge. And the construction part of operations is everything. I mean, that tenant is moving out of what a lot of times is a classic unit that is going to be fully rehabbed, and
Mhm.
you've got carpet or vinyl plank, you've got cabinetry or refacing cabinetry, new appliances, new lights, new vanities, tub refacing. So it's putting all of those components, ordering the materials, getting them all there, logistics, getting the team set up. There's a ton of moving parts in the construction, plus getting it back online at
Mhm.
on a timeline that isn't killing out the rent that you're never going to receive again.
Mhm.
But 20 days still on a full on renovation is not bad considering all of the moving parts that goes into it. And and it's not only one unit. You all are, I mean, your teams are in how many units a day are you all in right now?
So we have 3 teams, and so they average about 2.5 days per turn. So we're doing a little over 1 turn per day.
Got it. Yeah, that's great. That's huge.
Mhm.
How are you balancing out just all of the communities, your time, and making sure that operations is in a stellar position and making sure everyone's getting the right amount of attention from you in order to keep the operations where they need to be?
I mean that's a forever moving target, right? So like
Yeah,
I'm learning how to lead a company that has 50 employees, where before it was very different when it had 10, right? So um, I think what I've learned over the years is, as a leader, it's extremely important to create clarity. And sometimes it takes 10 times as much effort or intention as you think it will to create that clarity. So I'm just very, very fortunate as a leader to say my position is to create clarity within the organization, hire people that then can understand that vision, where we're going, and then reverse engineer their processes and fill any gaps to problem solve. And so, yeah, I mean, the it's 50 employees, it's 130 or 1,300 units, so it's not a massive organization. And so, I'm still very involved in I'm not very involved in the day to day, but I'm very involved in the organization and supporting our team to help them solve those problems.
yeah.
Um,
You get into
did I answer
managing
your question?
personalities at a different level too. When you've got a lot of personalities in an organization, managing the personalities and the different things that different people bring.
Hmm.
Because the wrong employees can make for a toxic environment too.
Hmm.
Um, Fortunately, that's the way some people just aren't cut out, where other
Hmm.
people can lift everybody up. Um, that's part of growth of adding to your organization.
Yeah, to that point, when we interview, and we now have a full-time HR person that helps us in the recruiting and interviewing process. We have been very adamant about saying we hire 50% for competency. So do you have the skills to do this work? And the other 50% is on values alignment. So it's not on cultural alignment. Like we don't necessarily want a bunch of the same people. We want people that have similar values. And so ours are driven, reliable, team oriented, continuously improving, and always do the right thing. Right. So in our interview process, half of the interview is asking personality questions to test if they have those values. And sometimes we get it wrong, but our intention is to hire people that have similar values. So then you don't have that, toxic person in the organization that is pulling everyone in the wrong direction.
Yeah, that goes right back to accountability too, though. If something happens, you go back to the core values, and then you see if you're out of alignment with certain situations. That helps. Have you all tapped into EOS at all?
So I've read Traction. I know the book well. I would say we took components of that and made it our own, but we're not subscribed to that exact model.
Got it. Yeah, it helps. We've been on it for a while, but it helps with clarity, helps with vision, with vivid vision as far as what the future looks like, and then hitting targets on getting there.
Mhm.
But with real estate, as far as getting there, it's got to be, like you had said earlier, methodical, and you don't want to just buy property to add units. It's got to be the wrong property can be just hell on earth for you too. So
Mhm.
it's got to be done. It just takes time, and it for the long game and buy to hold. So,
Mhm.
um, but yeah, EOS has worked out pretty well. Is there anything else that you can add that the listeners could benefit from?
I think you asked something earlier, and I was going to say it, so I'll bring it up now. I don't remember the question that prompted the thought, but you mentioned syndicators and like kind of the state of the market. And I just wanted to voice for anyone who, is considering raising money. I think one of the issues that we have currently is that syndication became quite popular. And so I just want to avoid voice like a word of caution or a word of understanding of what it means to actually raise money. And the way I frame it in my head to hold myself responsible and understand the responsibility that comes with raising capital is that each investor, whether they're, a billionaire or it's, your uncle who is pulling out of their, retirement account, each of them have traded some time, a portion of their life to earn that money. And so as sponsors or as GPs, we should hold that capital as sacred as we would a portion of a person's life. So I like to think like, how hard would we work and how hard do we work as a society to save someone's life? It's like, we'll do anything, right? Even if it means like, think of even like a cancer patient where it's like, I can give you one more year. What will we do for that? And yet we will raise money and borrow what someone traded 10 years of their life to earn, working a corporate job or whatever, and we'll toss it to a risky investment and put no effort to make sure it produces the right thing. I think syndication has not emphasized the responsibility that you're actually borrowing a portion of a person's life and to hold it to that standard and understand that responsibility. And so thanks for giving me the platform to say that, because I think not everyone has been thinking that through when they're raising money.
For sure. It became very commoditized in the past few years to go out there and raise capital and then place it in multifamily, and then everyone's trusting someone else. And
Mhm.
then at the end of the day, it's the like you had mentioned earlier, it's people doing working for people, and if those people are wrong in the operations to ground level, that's where the success or demise of the business, the multifamily, whatever it may be, could suffer, and then everyone else on the top does as well. But it's decisions that have been made by someone else who everyone else trusts. But your all's operation is full vertically integrated owner operator, so you've got an alignment of interest as well, just as much as anyone else investing capital alongside with you. It's a true alignment, which is that's in my opinion, it's the way it should be. It's great. Um, If somebody wants to learn more about you, reach out, possibly invest with you, how can they reach out?
I think the best method would be through our website. So at the beginning of the show, you said the name of our company. It's SNS Capital Group. So like 3 letters, capitalgroup.com. And there's a contact us button. That's probably the quickest and easiest way to get a hold of me. And then, Josh, you've done a great job of helping us get onto social platforms and sharing our story there. So if you're seeing this on those platforms, you can always reconnect with me through those platforms.
Awesome, Jered. Definitely appreciate your time. I look forward to following you, and we will talk soon.